Now, I know a lot of you don't like clickbait titles, so you're wanting to know right away which company we're going to talk about. Well, you need to put aside your 7-second attention span and try to guess for a second. So this is the largest steel producer and recycler in America. They're a company that's benefited a great deal from the Biden administration. They have a business model with a natural hedge, so 73% of their inputs are scrap, and that's tied right to steel prices. And they've increased their dividend now for 50 years in a row. So not just paid a dividend for 50 years in a row, but increased it. So we'll tell you the name of the company in a second, but first let's talk steel. So this is a great diagram that shows steel production by country in 2022. So America's steel production actually peaked in 1973 and has since declined by 40% as of 2022. Now, China is the leading producer of steel in the world by far, and they've dominated steel production since 1966. Now, here's a list of the largest steel companies, and as you would expect, there's lots of Chinese names there, but look there at the bottom in 15th place is Nucor Corporation. That's the company we're going to talk about today. Now, when it comes to that return that you saw on the thumbnail, that's no joke. So if you start investing at age 25, you probably have 4 decades of investment time in the market. So you would have fared very well with this Dividend King. So their 40-year return is around 13,000% compared to the S&P 500, which is at 3,600%. So we don't do politics here at Nanalyze, so I'm going to tell you a little story. It's about the land of the Nakarema. Now, if any of you can figure out the meaning behind that name, leave it in the comments section. This is a classic story they tell you in a sociology class. So in this land, there's 2 dominant political parties, the horses and the rhinos. Now, the horses say they want to build things better, and the rhinos say they want to make things great. Now, they both want the same things. They're saying essentially the same thing, but for some reason, everyone hates each other. Now, Nucor rose strongly following the last election in this country based on $1.5 trillion that's supposed to be spent on infrastructure. But there's another election coming up, and there's certainly questions about how that election might affect the money that's been flowing into Nucor's coffers, because nearly all of their sales are to the Nakarema. Now, the spike in share price that you saw on that previous slide, which is worth noting, this red arrow points to it, that wasn't just an anticipation of increased demand for steel. When we plot out the performance of Nucor against the S&P 500 over the past 4 years, we see they've returned 279% versus S&P 500 at 75%. Was that performance merited? Well, it probably was, and the reason for that is revenues spiked dramatically. You can see here that in 2021, revenues jumped 81% for a steel company. That's crazy. So the labels in this chart, by the way, are slightly off. 2020 should be one over to the right, and you can see that big spike, right? Now, how long is this abnormal growth going to persist? Well, I don't know. When you look at the Infrastructure Act, it talks about how you can expect job growth for a decade. So perhaps that's as long as it will take for all this investment in infrastructure to complete. But one thing to note is that yield for Nucor has dropped since the election. You can see here it used to frequently jump up to 4%, even above 4%, but now it's under 2%. And when we look at this company using our Quantigence dividend growth strategy, it actually ranks quite low. So let's look at why. First of all, you have the year's increasing dividend. Since it's a king, it gets a high score there. Of course, relatively small company. I think it's a $38 billion market cap. So that's not going to get many points there. Yield, it's actually being dinged on yield because it's so low. Payout ratio, this is crazy. Their payout ratio is somewhere between 9 to 12%. Very, very low. So they have a high score there, of course, because that payout ratio, a low payout ratio, gives you buffers so that you can increase the dividend even if you run into problems with your company. And then international sales, of course, everything's going to the Nakarema, so that's -2. 5-year dividend growth, they have a 1.4, but You see 10-year dividend growth, they're penalized, -1, giving them a total Q score of 7.8, which is quite low. One of the reasons why that 10-year growth is quite low is because they're just not increasing the dividend. Here you can see over the past 7 years or so, it's just been low single digits, and it looks like between 2021 and 2022 they had a 17% increase. So that's great, but when you look at the bigger picture here, the 3-year growth rate, of course, is higher because of that at 8.2%, but you look at the 10-year growth rate for their dividend, 3.3%. That's probably matching inflation. It's not very desirable, and that's why we ding that in our strategy. Dividend doesn't seem to be a priority for this company, but decreasing shares outstanding is. This is a good chart here. It shows us a couple things. First of all, I wanted to point to debt. So I know they used to have a lot of debt way back when, and they've since paid that down. It's more manageable. So their net debt is around $1.3 billion in debt they still have if you backed out the cash there. On the left of that, you see a 25% reduction to their share count since 2017. So this is interesting. What you can do if you're a dividend champion is you could simply buy back shares, and your dividends per share would increase because there's fewer shares total outstanding. So the pie is being split between fewer people. So just the act of buying back your shares increases dividend. It's somewhat intuitive, I suppose, but it's interesting to see that in action. I'll show you an example of that in a second. But here you can see share repurchases. This is from 2020 until their most recent quarter. Share repurchases around $8.6 billion, dividends paid $2 billion. So if they just stopped repurchasing shares and they could use that to pay out more dividends, but that doesn't seem to be a priority, as I said before. Here, when you look at their cash flow statement, this is rather interesting. The cash dividends there you see for 2022 and 2023. Look, they declined in 2023, but the fact that they acquired or they're purchasing their shares back means their dividend actually increased by just a bit. And you can also see here cash provided by operating activities is quite high. They need to make hay while the sun shines, and they are. So you see their capital expenditures there along the bottom increasing over time. Well, they're building out various projects. Here's a list of them in places across the United States. They show the budget there and what they're targeting. And that really brings us to what this company does. In case you hadn't figured it out, it's steel, right? And there's various forms of steel. Quite interesting. Look at this. You have sheet, bar, structural, plate, tubular products, etc. And that's the segmentation that you get when you look at their financials and the total revenues there. So you see in 2021, $36 billion, then it jumped in 2022, $41 billion, then dropped in 2023. So fairly volatile. What's also interesting is they're using some of that money to acquire other companies. I think they acquired a door company, which uses a lot of steel. But looky here, they're acquiring some sort of a data center outfit, Southwest Data Products. Now, I don't know how much steel goes into data centers, but certainly it's the healthy margin that they're looking at there, and it's probably overall a small percentage of what they do. But I thought that was rather interesting. Now, this company has a surprising green appeal for being a steel company. So it says here, as North America's largest recycler, Nucor typically recycles 22 million tons of scrap annually, including 9 million cars. Steel can be infinitely recycled and reused without any quality loss. And Nucor's steel products are made from an average of 77% recycled content. That's crazy, right? They should have a high ESG score, I suppose, though ESG scores are largely useless, as we've talked about in previous videos. But Nucor's business model is interesting. I alluded to this earlier. They produce steel and electric arc furnaces that have a lower fixed cost structure, and they use steel scrap as the raw material. Now, since U.S. steel prices tend to follow scrap prices, that gives them a natural hedge. So their method of production is unlike blast furnaces that are used by companies like U.S. Steel. U.S. Steel's method of producing steel has a higher fixed cost structure, and they use iron ore as the main feed, and those prices don't move alongside U.S. steel prices. U.S. Steel actually, I know it's confusing, right? So U.S. Steel, the company versus U.S. Steel, but U.S. Steel, the company, mines its own iron ore in the U.S., and that's a complicated deal there, whilst Nucor's business model is very unique. That's why they have a strong balance sheet, and they've been able to achieve that Dividend King track record. Now, when you look into their financials, you see some interesting stuff here. Look at raw materials. So the table on top says net sales to external customers, right? That's the revenues we looked at before. But look at intercompany sales. Look at raw materials. That's a table below. They do those corporate eliminations, right? So they're essentially supplying themselves with an awful lot of raw material. So this is almost reminiscent of Exxon's business model, right? Where they have upstream and downstream, right? And the two provide a natural hedge there. So very interesting company. Now, I wanted to touch quickly on the spike in revenues for Nucor and how that related to steel prices. And I thought this was interesting how steel prices spiked following the pandemic. So it wasn't just the Nakarama spending $1.5 trillion on infrastructure. It was that steel prices went through the roof, and that's because of COVID-19 and how steel mills were quick to idle their furnaces and curtail production instead of risking uncertainty. And then there was a resurgence in demand. What do they call it? The whiplash effect in supply chains, is it? And then there was a raw material scrap shortage, and as a result, steel mills aggressively raised prices to take advantage of the shortage, and everybody made out like bandits. Now, just some thoughts on Nucor. As a result of that low payout ratio that they seem to want to keep, the 10-year dividend growth is quite low. It's pacing inflation. Yields under 2%, not growing very fast. That's not very attractive for income investors. At a 4% yield, this company might be more interesting and certainly give it a higher Q score if they got that growth going, dividend growth going, which they can. They have the low payout ratio that would allow them to do that, but they don't seem to want to. And the lack of international revenues is a big concern, right? They're dinged for that. And you have the curse of oil problem, right? So the idea here is that when you have really good times, as they have experienced lately as a result of all that spending on infrastructure, if they don't invest that properly, then there will be bad times soon. And it looks like they're managing that sufficiently. So I'm going to go ahead and leave you with another interesting video that we did on dividend stocks you might enjoy. Do me a favor and just go into the comments section, please, and subscribe to our newsletter. We teach people how to become better investors. You'll find it to be free of fluff and quite informative. Thanks so much for taking the time to watch this video today.